So he's got to figure out how to do this. And so what does he do? What's the means that he can create a level playing field?
So the technical thing they figure out is what they need to do is slow down high-frequency traders' ability to get information from their exchange and to trade and to respond to it. So what the high-frequency traders are doing at every other stock exchange is putting their machine right next to the machines, the stock exchange machine. Right. So they get fastest information out of the exchange and can respond to it. So they know prices before you and I know prices. So the way he does it is they call it the magic shoebox. They coil 60 kilometers of fiber optics inside of it looks like a shoebox. It looks like a big fishing reel inside of a shoebox. And so when a high-frequency trader tries to trade, instead of going right into their exchange, it goes boom, 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 boom around it. It slows it down. So the effect was to put them in somewhere way out in Long Island. I mean, they effectively banished the high-frequency traders some distance. And then what they had to do was create a really, really fast route from their exchange to all the other exchanges. So if a customer order came on and, to buy 10,000 shares of Microsoft, and they on their exchange only had 5,000 for sale, but there were some elsewhere, they could get to them before on behalf of the customer, before behalf of the investor, before the high-frequency traders could. So they went and dug essentially a high-frequency trading system in New Jersey for their exchange.
And guess who's investing in this new exchange? Goldman Sachs?
No. This is important. They identified as an important conflict of interest the fact that all the other exchanges are owned by brokers and high-frequency traders. And so
they said we'll be owned by?
We'll be owned by investors. We'll be owned by big mutual funds. Right. We'll be owned by David Einhorn has an investment in it. People who are actually managing money, and all they want is a fair, honest place to buy and sell stocks. So there's no pressure to queer the game in favor of intermediaries. So what Goldman Sachs did, and this is where the story thickens to me, because Goldman Sachs clearly, at the time they're putting the Russian in jail for stealing their supposedly precious high-frequency trading code, they clearly think they're going to get in the high-frequency trading game. I mean, that's why they care so much about it. They clearly had a change of heart. And something's going on inside. I think something interesting is going on inside of Goldman Sachs right now.
And what do you think it is?
An argument about what our role in the society is. How can we function as an institution if people don't trust us?
And do you think they're losing the trust of the public at large?
I think
they lost it way back in 2008. They lost it way back. 2008.
And I think the question is, do they need to get it back? It's partly a practical argument. It's partly a moral argument. You can argue that reputation doesn't matter anymore. That all that matters is brute force in the financial system, and who cares whether people think we're screwing them or not.
But when Michael Lewis tells me there's a debate going on in Goldman Sachs, I assume someone has told him there's a roaring debate going on here, and we're trying to figure out who we are and what our role is.
Yes. And a microcosm of this debate is the argument around how they should behave in the stock market. And some new guys came in and took over Goldman Sachs' stock market business, trading and sales business globally. And they looked at the way Goldman had conducted itself. And they looked at the way the exchanges were arranged. They looked at the rigging in the market. And they said they had two observations. One is, there's basically a corruption here. I mean, there's basically a skimming, scalping going on that's unpleasant, unsavory, and will look bad if anybody ever figures it out. But two, they thought that the system, the stock market that has grown up, as it's structured, all these different exchanges, lots of complexity in each exchange, all designed for the benefit of high-frequency traders.
Technology is roaring ahead.
It's very unstable. And they said to me that the flash crash back in 2010, NASDAQ shutting down for hours, various outages at various exchanges. This is a pattern here. This is symptomatic, they said to me. They said, if we don't do something to repair the stock market, there's going to be a flash crash times 10, a calamity. And we know that if that happens, Goldman Sachs is one way or another going to get blamed. So what's the solution here? And they said the solution is this Canadian guy who's built this fair exchange that's quite simple, very robust, and we're going to throw our weight behind it. Now, inside of Goldman Sachs, that was not a universally populated decision. These new guys had come into the Ron Morgan and Brian Levine are their names, had come in.
They're not going to invest in the new exchange, but they're going to use the new exchange.
Just the opposite. They don't want to have any conflict.
Right.
What they're going to do is take their customers, their orders, ordinary investors' orders, and send them to the exchange and have them executed there, so they can't be exploited. So that costs Wall Street generally a lot of money. I mean, I don't know how much the take is every year, but $10-20 billion a year is being scalped. It's essentially unnecessary financial intermediation that's happening. High-frequency traders standing in between buyers and sellers when the buyers and sellers could very well come together at a better price for both without anybody in between.
And they're taking away $20 billion.
Whatever it is, they're going to take away lots of billions of dollars. So and some of that money would have been Goldman Sachs' money, one way or another. So it's a short-term decision. It's a decision to sacrifice short-term profits in their long-term
But you're saying this is even a bigger decision and a bigger debate than simply high-frequency trading. Well, it has to do generally with how we conduct our business.
I think that's...
And what is at risk for us.
I think that's so. I think they figured out that their business is hard to do without people trusting them. And I think they figured out that they can't really compete as high-frequency traders for a lot of reasons. That this business, the high-frequency trading game, it's just done more effectively by small, nimbler groups of people than big banks. So they can't play in that game anyway. And I think they figured out that if at least in a stock market, if the whole stock market jumped onto Brad Katsuyama's exchange, if it all just ended up on IX, which is not inconceivable, Goldman Sachs would
be a very rich man.
Would enjoy a relative advantage to a lot of the other banks because their advice is more valuable. They think they can compete on other ways. But I think the interesting thing is that this conversation is clearly taking place inside of Goldman Sachs in this market. And
how would you characterize the people who run Goldman Sachs then?
Brad Katsuyama taught me something because he had to go into all of these banks to try to persuade them to send them his exchange orders. And a lot of them really don't want to do it. They're really doing whatever they can to torpedo the fair exchange. But if I were him, that would make me, I would be cynical. But he seems to think, and I think he's right, that the banks aren't monoliths. They're like different factions, different people who have different incentives within the bank. So these guys who are reformers inside of Goldman Sachs, now why are their incentives different? One, they have to face customers every day, and they know these customers. Two, they're older guys. By Wall Street standards, they're ancient. They're in their late 40s, and so their careers are at a different stage. They're less concerned about next year's bonus, and their bonus is not driven by how much Goldman Sachs' dark pool, which is their private estate, makes, that kind of thing. So they have a different incentive than maybe some other people in Goldman Sachs, and all the firms are that way. I think there are arguments inside all the firms of how we behave in the financial market, and I think Goldman is a harbinger. Goldman tends to lead the street. It's
the most powerful and the most respected.
Yes, I think everybody else looks at what Goldman's not doing and is saying, why are they doing that? Now, I think it's fascinating that they've made this call to help reform the stock market at almost exactly the moment the New York Attorney General announces an investigation of high-frequency trading and the exchanges and all of this, and then the FBI reveals it has an investigation.
He was on television with me this morning, the Attorney General of New York, saying just that he'd been monitoring it, and now he was going to accelerate, what they were planning to do, but partly because of the conversation that's erupted because of your book.
This I don't know, but I'll take your word for it.
Well, yeah, okay.
I mean, I'm sure that these investigations have been going on for a while. It's just a question of how hot they get.
Just monitoring. I'm not sure about investigation. It may have been the word he used. Okay, so here we are. We figured this thing out in terms of and is there a dollar amount on how much the high-frequency traders were making because they could front-run this thing?
No. I don't know the answer to that. I can tell you that they've been, that IEX, Brad Katsuyama's exchange, the research they've done has tried to generate some numbers, they've identified specific strategies, predatory strategies, and try to determine just like how much might have been made from that one. And it's clearly many billions of dollars a year, but whether it's $8 billion a year or $30 billion a year, hard to know. You can and the only other way to kind of guess it, I mean, this is because it's private information. These firms do not have to reveal how much they're making in the stock market or how they're making it. And some part of their activity will survive reform in the stock market. That there's no doubt some useful function that some high frequency traders are performing, and it's different from shop to shop. But you can see things like how much they're spending for speed. And it's billions. I mean,
are movie companies bidding on this already?
I don't know. I mean, it's only a day old, a day and a half old.
Anybody. That's another issue about this. Enormous secrecy about this book. It wasn't even in the catalog of Norton.
The book has mirrored its subject matter, hasn't it? I mean, the subjects all operate in such stealth. It's the whole thing. I mean,
so the book was stealth because all the subjects were stealth.
Well, the book ended up being a secret just simply because, I mean, the truth is that 60 Minutes decided they wanted to do something with it.
And they had their own rule.
And they had their own rule.
Yeah.
So we just wanted to let 60 Minutes have first crack at explaining this to the world.
What does being on 60 Minutes mean for a book like this? A great television program, in my judgment, obviously, but I'm biased.
So there are two things. One is Steve Croft, who did the piece, also did a piece on The Big Short. Right. And I watched him frame the conversation in a way that was that the television audience could completely grasp. Yeah. And it was very useful. It made it easier for me to go talk about the book because people kind of got it. He made it visual. So it's a very big deal in terms of communicating what's in the story. I'm sure it sells a lot of books too, but I don't know how many.
Yeah.